Welcome back, ladies and gentlemen, on this fabulous Friday for what is going to be nothing short of another jam-packed daily cryptocurrency market update. And today is a big day. We have employment data coming out for the United States. Now, this is, of course, going to affect the speculation on interest rate pricing, thus the dollar and thus the markets. We're going to be breaking all that down in this video. Unfortunately, the cryptocurrency market is in a bit of a doldrums. However, we do believe we are in a broader uptrend and there are brighter days ahead of us. And before we get into all that, I want to take a look at the yield curve, a recession indicator that has had a surprising degree of accuracy. We're going to be diving over to the yield curve. We're talking about the 2s and 10s here, or the 10s and 2s. And we're ultimately going to be looking at what happens when the yield curve goes from inverted to uninverted and what follows it. Now, this has got many people speculating on a crash for the markets to come. However, we're going to be looking at an interesting take in regards to this. So we have a hell of a lot to get into. We'll be looking at the Bitcoin chart, of course, also looking at some takes on the Fed and their rate cutting cycle that they may be going into and what people think they should do, what some Nobel Prize economists think they should do. So as always, a hell of a lot to get into. Let's start the video off, as promised, with a look at the yield curve. So the yield curve is the one that we look at. There's a few yield curves out there. We're looking at the 10-year and the 2-year yield curve. And the idea here is that if you lock your money up for a longer period of time, you should get a better return. And there's been a kind of skew. When the yield curve takes place, it means that the 2-year yield is offering a better yield than the 10. This is known as an inversion. And you can see this is signaled with the yield curve going below that 0 mark. And every time there has been a yield curve inversion, typically a shitstorm has followed. However, there is variation in this, and is this time going to be different? There's a real kind of danger in regards to expecting something out of the ordinary. However, we will be looking at a take from RAM in regards to this. Even if the yield uninversion, which we are on the cusp of, in fact, we've had a yield uninversion in regards to what took place with the Japanese yen unwind. Even if we do go into an uninverted state, there is always a period from going uninverted to the actual crash takes place. You can see, of course, the March 2020 crash after a point of uninversion took 168 days. The one prior to that took 154 days. You could have perhaps gone all the way back and looked at this inversion, the initial inversion over here, but we've took it in regards to the more permanent one. You know, there is variation here. You could look at it from this point, you could look at it from this point. In the dot-com crash, the markets were already crashing due to the specific nature of what took place there before the uninversion took place. And prior to that, it took 364 days for an actual crash of the 1992 crash to take place. So, yes, there is an increased probability in regards to a recession or a crash based on the historic correlation between the yield curve uninverting and the markets. However, there is always a variation in regards to how long it actually takes for a crash to take place. For example, you can see this uninversion here. A crash didn't play out till, a good couple, 2.5 years prior. So there's a lot of variation here. It's not an imminent sign, if you will. However, it is an increased probability of a crash coming on the back end. And this is something to watch. I think we need to look at economic data. Remember, the S&P, a great stat for you guys, will rally within 2% of a recession, meaning it will only price in a recession 2 months prior to one actually taking place. So we're not as worried about this as many people are making it out to be. We've also completely dispelled the notion that every time the Fed cut rates, it's bad. If you look at the past 12 times the Fed have cut rates, only twice has that been negative in regards to the 12-month returns of the S&P from when they did that initial rate cut. The other 10 times out of the past 12, the S&P has actually done pretty well. And we think this is going to be the case this time. I just want to dive over to a very quick tape here from Ram, who was an ex-Wall Street individual. Yield curve disinversion. So uninversion is the term we use. He's using disinversion. Does that mean a recession ahead? Isn't that a bad indicator infallible? Or isn't that indicator infallible, meaning it's got a very good degree of accuracy, which we can see here. Again, always got to be careful with saying this time is different. Correlation is not causation, always something to remember. A mechanical rule-driven approach is comforting. We can stop thinking and just do what the indicator says, but that's a mistake. This was a very interesting take I want to share with you guys. At the end of the dot-com era, we had a yield inversion curve, or an inverted yield curve. There was a massive Y2K capex binge, fiber slurp, and VC binge. The cause was the unwinding of excess investment, a classic sign of a top along with excess credit. We had a recession in the dot-com era driven by reversals in capex spending and an increase in unemployment in tech and telecom. The 2008 financial crisis was preceded by an inverted yield curve. So obviously, of course, he's talking dot-com crash, inverted yield curve, and of course the 2008 financial crisis. Let's continue on with this tweet. This episode was marked by a different sort of capex boom, this time driven by consumers in residential real estate and fueled by cheap credit and Wall Street's securitization machine. The unwind started with a credit crunch, classic Minsky Phase 3 top. We also talk about Phase 3 tops in our Market Mastery course. Where we stand today, we have capex growth around AI, data centers, and infrastructure. I'd also argue crypto, but to a far less degree, because it's not quite in the real world in the same way that these other technologies are. The real world, of course, it is in the real world, but in regards to actual integration. That's funded by cash-flushed hyperscalers and government spending at wartime deficits. That capex spending is not stopping. Is there a credit crunch from high interest rates? Yes, in commercial real estates. Rising Fed funds always break something. It's not a tech stock or banks in 2008. This time, it's a private market rather than a public one. So everyone is conditioned for the shoe to drop and waiting for long and variable legs when the shoe already has dropped. The credit event that a lot of people were worried about last year is a local CRE market. Today, there is a lot of concerns about macro again and geopolitical risk and curve disinversion. And yet, we just wrapped up one of the strongest quarters of earning growth since Q4 2021. Rate cuts help consumers and small businesses. Don't confuse correlation with causation. Maintain perspective. Bull markets are born on pessimism. Grow on skepticism, mature on optimism, and die on euphoria. And we still think there is euphoria to come in the markets, ladies and gentlemen. The markets typically always do very well when the Fed has a not so strong economy, but not a recessionary one, and is trying to goose it, which is what they're going to do with interest rate cuts, which we're going to get news or further clarity in regards to the direction of those coming out later today with non-farm payroll. The markets typically do well in that environment. We've covered this to death. We have every technical reason, every macro reason, every fundamental reason to expect the markets to do well. And don't let, which is why I wanted to show this tweet, a yield curve on inversion, which there's variation with in regards to when the crash actually takes place, shake you out. You can see really the yield curve uninverted here, it went back into inversion. This is not the yield curve uninverts and then there's a crash mechanism. And go and look at this for yourself. It's always good practice to do because this is going to likely become, providing we continue with the kind of debt-based system that we have, an ever-present stat to look at when it comes to the market. So we really like this take. It very much aligns with ours. Of course, today you have non-farm payroll. We're expecting a higher non-farm payroll than we had in the previous one. The Bank of America is actually expecting over 2,000 jobs added, so a huge beat. We also have unemployment rate expected to drop. This is the thing, like if you look at the Sharm index, which is very good at predicting sort of downturns in the economy and the market. The individual that came up with that very valuable index even came out and said it doesn't no longer work due to immigration that we see in the US and how it's skewed things. There's a lot of skewing in the markets and you need to apply, for me personally, technical precedent over your analysis. So today, it's going to be very interesting. The correlation, of course, with markets, unemployment up, typically not an economic boom. This is counter intuitive or counter to global liquidity, PMI cycles, business cycles, election cycles, Bitcoin 4-year cycle theory. And we go with what we think is more probable and there's more evidence for. And just because there's an inversion, again, there's a kind of difference or a variation in regards to how long a crash actually takes to play out, and i.e. the market starts to price that in. But on top of that, this time genuinely could be different because we're under a different set of circumstances, just like the individuals that were predicting when they upped the debt ceiling, a crash to take place like what took place in 2019. We don't think, or didn't think that was the case. So after the data you have today, this is going to increase speculation on Fed rate cuts. Fed rate cuts are ultimately going to drive the dollar down, which is ultimately going to see risk assets do well. We've covered this to death. Not only do we have all this fundamental reasoning and, of course, macroeconomically what a reduction in the cost of money actually means. We saw an adverse of that with the Japanese yen carry trade readjustment based on them upping interest rates. We're getting the adverse of that. We have every technical reason, every macro reason, every fundamental reason to expect the markets to do well. And a lot of it pivots around the dollar, which has found support, leaning on risk. And ultimately, we've seen that play out in the risk market and still are. In regards to Bitcoin specifically, we are going to be doing a live stream tonight potentially. So do stay up to date for that, where we're going to be talking about the situation with Bitcoin and crypto more broadly, an hour or so. We believe there is every reason, again, we've covered kind of macro fears and speculation and kind of maybe put the genie back in the bottle, if you will, there. But we have every technical reason to expect Bitcoin to do well. It's a shame right now. We think there's a lack of volume and interest in the cryptocurrency space. It's very much trading like, almost like a commodity people have forgotten about. Look at these swings. This is crypto, ladies and gentlemen. 17% down. 19% up. 18% down. 21% down, 26% up. I mean, this is crazy. So you can imagine 25% down what your altcoin market would have done. High risk, high reward with these markets, guys. You really have got to stay focused. 30% up. You know, ultimately, I do think the volatility is somewhat reducing on the back end of, and it often does on the back end of a real event like the yield curve. Sorry, not the yield curve, the Japanese yen unwind. You're getting a reduction in volatility. I ultimately think this breaks and goes on a broader trajectory, and there might be a tipping point in regards to what we're going to see come later on the back of non-farm payroll. Certainly better data than expected. I think that actually is bad for the dollar because it increases the probability of rate hikes, which drives it, but good for risk markets generally that don't do well when unemployment is upticking. We've spoken a lot about macro, sort of big picture Bitcoin, where we think it's going. It's essentially on the same trajectory as gold that we, of course, were very accurate on calling. Gold's going higher. Stocks are going higher, in our opinion. We've got a video coming out on Tesla potentially today or tomorrow. Again, if Tesla's doing well, what's that environment suggestive of? And we've got a number of stocks that we've got higher prices for. Many small stocks in this kind of phase one, breaking into phase two, ready for uptrends. There's been a lot of takes in regards to the Fed. Fed won't push the panic button and go for a jumbo rate cut, economists say. They might not on the first one, but if you look at Fed easing cycles, and we'll put it on the Dixie chart, they are always aggressive. They don't hang around. It doesn't take them as long to lower rates as it does to sort of bring them up, if you will. So I do think the first one might not be. They might, be okay, but when they can see that they can kind of do it under a good context, they will, certainly if there is any sort of wobblers. And you've got a Nobel Prize winner, Joseph, says Fed raised rates too far, too fast, and now needs to cut. They will be cutting. We're going to get data on that later on today. I just wanted to cover the yield curve because a lot of people ask me about that naturally because of its sort of proven track record of predicting a crash or a downturn. There's variation with that. You need to take that into account. You also need to take the environment that we're in into account and ultimately sort of come up with your own narrative. Don't let this happen last time be the sole reason why you're essentially in the situation or believing the situation to come is to come. So that is it from me, ladies and gentlemen. I'm looking forward to reporting tomorrow on what the jobs numbers was and what the effect was on the market on Saturday. On that note, guys, I'm going to love and leave you. I hope you enjoyed this content as much as I enjoyed presenting it, and I will see you all in the next one. Thanks a lot for watching, guys. See you in the next.